So hello, everyone. How are you doing today? Um, we're about to start chapter 1, right? So we've already finished chapters 9, 10, and 11. And now we start chapter 1, which sounds kind of silly because why are we starting all over again? Well, the reason is because we're using a new book. So if you go on to the ebook and you click on the table of contents, right, you see starting chapter 1, 2, 3, 4, etc. Right? This is where we started, chapter 9, 10, 11. Right? And now here's where the new book begins. The white cotton book. So notice this is called managerial accounting, and this is a different approach to accounting. Up to now, everything that we did came under the heading of financial accounting. And financial accounting is predominantly concerned with preparation of financial statements that are used by parties outside the organization, and mostly investors and creditors. So what type of information would investors and creditors like to see? And we have to follow rules to do that. Those rules were called GAAP, generally accepted accounting principles, to make sure that there's some consistency in how accountants prepare the statements. So in other words, I'm an accountant here in New York, and I prepare statements the same way an accountant in Los Angeles or Chicago or Dallas or any place else, we would prepare the financial statements the same way. We follow the same rules. Because if everybody just did what they wanted, right, you would have anarchy, and the statements would really become meaningless. So we are going to start chapter 1. And, in a lot of books, like chapter 1 isn't that important. In this book, it is super important because some of the terms and concepts that we introduce here are things that we're going to see for the remainder of the course. In fact, if I had to pick one word that we're going to see over and over again and in many different contexts, the word cost, C-O-S-T, simple little word, 4-letter word. You probably say it 100 times a day in different aspects. But what is cost? How do we define cost? And if I had to say just very briefly, right, because we'll get more and more into this, when you hear the word cost, at least up until now, the way we've used the word cost, you would think of an expense, right? What does your rent cost? What are you paying in taxes? What are your taxes costing? How much interest expense do you have? How much interest cost do you have, right? So when you see the word cost, you would think cost of doing business and expense. And expenses belong on the income statement in the operating expense section. But cost could also mean asset. How much did your car cost? Right? You just bought a new car and somebody's going to ask you, how much did your car cost? Or you just got the latest cell phone. Someone says to you, what did your phone cost? Now, when someone asks you a question like that, if you want to be a bit of a wise guy, you could say to them, well, gee, what exactly do you mean by that? Do you want to know what the phone cost, the instrument that I'm holding in my hand, right? Because that's an asset. Or do you mean how much do I pay every month to my service provider, like AT&T or Verizon or T-Mobile or whoever you use? Right? Because sometimes cost can mean expense, your monthly phone bill, and other times Cost can mean the asset itself that you purchased. So what's the difference between an asset and an expense? Well, an expense is something that only benefits a very short period of time, one period that belongs on an income statement. Whereas an asset is something that is a cost, yes, but it's something that's going to last for a while. It has a future economic benefit. And then you have some assets like inventory that, well, yeah, they're assets, but they're usually not things that we like to hold on to too long, right? Now, if I buy a new computer or a new phone, I may use those things for 3 or 4 years. So it's clear to see that they're assets. But if I buy inventory, I don't want to hold on to my inventory for 3 or 4 years. I want my inventory to sell out right away. Excuse me. And when the inventory sells out, that becomes cost of goods sold. So not only are we going to study cost, but we're going to study all of these other concepts of how costs become expenses, how assets become expenses, how costs become inventory for companies that manufacture products, and how eventually how the cost of the inventory becomes an expense. It becomes cost of goods sold when the inventory is sold, right? So that's kind of the direction we're headed in. And you can see here by looking at the learning objectives, you can see that we really get into cost, right? And this is just the beginning, because we're going to see that we're going to elaborate on these definitions of cost, and we're going to see practical examples of how this translates into numbers as we proceed through the course. So the first thing they want you to know, or they try to explain to you, is what's the difference between financial accounting and managerial accounting, right? Now, we just spent 11 chapters on between Accounting 101 and Accounting 102. We just spent 11 chapters on financial accounting. And notice what they say in the definition here. Financial accounting is aimed at external users, those outside the organization, such as investors and creditors. Whereas management accounting or managerial accounting is aimed at internal users, the management of the company. All right, so here they give you kind of a comparison of financial accounting to managerial accounting, and they start out by this user perspective. In other words, who's going to be using the information? And as we just said, that with financial accounting, the users are external parties for the most part. Whereas under managerial accounting, the information is used internally by company management. You know, you're managing the business. You want to make sure that the business achieves its goals, right? So management will require different reports than financial accounting provides. What are the types of reports? Well, the financial statements prepared according to GAAP, right? Under financial accounting, that's the goal, to prepare financial statements according to GAAP. Whereas for managerial accounting, the reports can take on any shape. Now, sometimes they'll look like the financial statements, but other times there'll be variations on those financial statements. They could be things also like budgets or projections, different types of analysis, a performance evaluation. I don't know if you have a job or not, but have you ever been evaluated? Did you ever sit down with your supervisor and have a performance appraisal? Right? Well, that's a type of managerial accounting report. The nature of the information, it's objective and it's historical under financial accounting. Under managerial accounting, it's subjective and it looks into the future. Frequency of reporting. Under financial accounting, we are required to prepare financial statements periodically. It's usually at least annually, uh, and it could also be quarterly and monthly. If you're a publicly traded company, you are required to report quarterly, annually, and quarterly. Under managerial accounting, you can prepare reports for whatever time periods you deem relevant. I used to work for a company, and the vice president of sales demanded to know every day how much product was being shipped, right? Because he had his own forecasts, his own projections, and he wanted to see how close he was coming to meeting those projections. Because, again, if you wait too long, if you wait until the year passes and then go back and say, gee, what could I have done to make this better, right? No, you want to look at things all the time to see if you're on track to achieve your goals. And if you're not, can you change the plan so that you meet the goals? And the level of detail, under financial accounting, we report on the company as a whole. A lot of companies are made up of subsidiaries. Take a company like General Motors, right? What's General Motors made up of? Chevrolet, Cadillac, Buick, GMC, right? I don't even know what other companies are involved, right? But General Motors is really a group of 5 or 6 corporations that report under one entity. But under managerial accounting, you can report the information any way you want it, by subsidiary, by product, by region, by customer even. You can have an income statement for a customer. They go into now a discussion of the functions of management, right? This is all background information for you. And this is something that you may have seen in other business type classes you could have taken, like a bus 110 or a bus 112, right? You may have seen this information before. But what are the functions of management, right? There are 3 main functions: planning, implementation, and control. So what is a plan? A company sits down and says, okay, what do we want to accomplish? We have goals, objectives that we want to meet. And we set a plan in order to do that. Then implement, we put the plan into action. We actually do the things that or at least we do the things that we think we need to do to meet those goals, the goals that were established when we created the plan. And then we need to go back periodically and monitor the results of the plan to see that it's on track to meet the goals. And if it's not, we need to make adjustments. We need to revise the plan, right? And then put the new plan into effect, right? And then monitor it again, right? So notice this is like a circle. This is a continuous circle. This isn't done once and you forget about it. And then this is done and you forget about it. And this is done and you forget about it. It's an ongoing process. Excuse me. So what are the different types of organizations here that we get involved with in this part of the course? In Accounting 101, we were looking mostly at service companies in the beginning, and then companies that sold merchandise later on. In this part of the course, we're going to be primarily concerned with the manufacturer of products. Manufacturer, the ones that actually make the products. So when you go to Macy's and you go to buy something in Macy's, they didn't make that thing. They bought it from somebody who made it, right? The manufacturer is the one that actually makes the product. I'm skipping over some things here that really aren't, I'm not saying they're not important, but they're not important to me in terms of what I want you to get out of this chapter. Okay, so now we start to get into this discussion of cost. And notice how we can look at cost: direct, indirect, variable, fixed, manufacturing, non-manufacturing, product, period, relevant, irrelevant. So let's start with this direct, indirect. A direct cost is one that can be traced. Now, we're going to be talking about manufacturing. So a direct cost is one that can be traced directly to a cost object. In our case, right, when you think of a manufacturing company, they're making a product. So are there any costs that are involved in making that product that can be traced directly to that product? So let's say we're making a shirt, right? Whether it be a men's shirt or a woman's shirt, we're making a shirt, a garment. Well, think of the main cost that would be involved in making that garment. How about the cost of the material, the cloth that's used to make that shirt? Every shirt that we make requires cloth. And we might even get more particular and say every shirt requires the same amount of cloth. So I can trace whatever I paid to buy that cloth, I can trace it to that shirt. That's something that's known as direct material, right? Very important term, direct material. Every shirt requires cloth. Every shirt requires the same amount of cloth, direct material. Now, we all know that the shirt needs to be sewn together, right? We just don't take a piece of cloth and throw it over ourselves. It has to be sewn together. We have to pay someone to sit at a sewing machine and sew that shirt together. That's another example of a direct cost. I have to pay someone to sit at a machine and sew that shirt together, and I pay that person a salary. That's known as direct labor. See, it's not salaries expense. It's direct labor. I can trace the cost of that person's labor directly to that shirt. So when you think of direct costs, I want you to think of direct material and direct labor. Now, what about indirect costs? Well, I know that I have other costs that are involved in making that shirt, but I can't trace it. Either it's not physically possible for me to trace it, or it's not worth the effort of tracing it. Maybe the cost is so minor, it's not worth the time it would take to figure that out. Right? So these are known as indirect costs. The classic indirect cost is overhead, manufacturing overhead. Now think about it for a second. I'm making this shirt. I have a factory, and in this factory, I'm making shirts. So I know direct materials, the amount of cloth that goes into making a shirt. I know direct labor, the cost that I have to pay for someone to sit behind the machine and sew the shirt. But what other costs are involved? Any other cost that took place in the factory that's not direct material or direct labor is manufacturing overhead. So what about things like rent? I had to pay rent on the factory building. Can't trace it directly to the shirt, but yet without the factory, I couldn't make the shirt, right? So it's an indirect cost. So things like rent, depreciation, any other salaries that I pay for people that work in the factory that's not direct labor. For example, supervisors, um, maintenance, mechanics who fix the machines, depreciation on the machines, insurance on the factory building. These are all examples of indirect cost manufacturing overhead. Now, variable versus fixed. Some costs don't change. Those are fixed. Some costs don't change. Rent. I pay the same amount of rent whether I make one shirt or 10,000 shirts, right? I have a factory every month. I have a lease. I have to pay the same amount of rent. I have to pay that supervisor every week, whether I make one shirt or 10,000 shirts. Those are fixed costs. They stay the same regardless of how many shirts I make. Insurance would be another one. Depreciation would be another one, right? These are classic fixed costs. What about utilities? Utilities are funny, and so is maintenance, right? Those are what are known as mixed costs because they have a fixed element and a variable element. Now let's talk about variable for a minute. Variable costs change with the level of production. So the more shirts I make, the more variable costs I have. Think of direct material and direct labor as being variable costs, right? Direct material and direct labor are variable costs. Now notice how they show it graphically. The more things I make, the more the variable costs increase, right? But the unit variable costs are the same. In other words, if I have to pay $5 a yard for the cloth, right, that doesn't change per shirt. If I have to pay the person to sew the shirt $10 an hour, that doesn't change per shirt. But naturally, the more shirts I make, the more those costs are. But on a per unit basis, per shirt, notice those costs are the same. So again, when you're thinking of variable costs, think of direct material and direct labor. When you see fixed costs are the same no matter how many I make. Right? No matter how many shirts I make, my rent is the same. But on a per unit basis, right? And per unit fixed costs to me are meaningless. I don't even know why they show this, right? But I think they're just trying to demonstrate the more shirts I make, if the cost stays the same, the more shirts I make, the unit cost decreases, right? Whereas here, the unit cost stayed the same. Now, what about overhead? We said that the direct material and the direct labor would be examples of variable costs, and things like rent would be an example of a fixed cost, right? And then things like maintenance might be an example of a mixed cost. Right. Again, we'll get more into detail as we do this. Now, what's the difference between manufacturing versus non-manufacturing costs? Manufacturing, everything that takes place in the factory. Direct material, direct labor, manufacturing overhead, right? Now, again, I'm going kind of quick through this. You should really take the time in this chapter. You should really take the time, and I don't say this a lot, but you should really take the time in this chapter to read this stuff, right? Read this stuff because it's important. We're going to see it over and over again. All right, now some more definitions of things. Prime cost. What is prime cost? Direct materials plus direct labor. Prime cost, direct material plus direct labor. Conversion cost. What's conversion cost? Direct labor plus overhead. Right? And again, the reason I'm going over this with you, when you do get to your homework, you're going to need to know these things. Non-manufacturing costs are the operating expenses. The general expenses, the administrative expenses, the office type expenses, management salaries, rent on the office building, utilities on the corporate headquarters, right? And the service departments like HR and accounting and payroll and things like that. Right? Those are all examples of your general and administrative expenses. And then you also have selling expenses, commissions, advertising, salaries of the salespeople, etc. Now notice they talk about manufacturing versus non-manufacturing. The manufacturing costs are going to go into inventory. Right, so keep that in mind. When we take this direct materials, direct labor, manufacturing overhead, what are we doing with those? We're creating inventory. We're building, making inventory. These non-manufacturing costs, right, are the costs that kind of every business has, regardless of whether you're a manufacturer or not. You still have office expenses and selling expenses, things like that. Think in your income statement, right? These costs up here, got to be careful I don't say expenses. These costs here, manufacturing costs, will eventually become part of cost of goods sold on your income statement. And these non-manufacturing costs are going to be the what? The operating expenses on the income statement. And it might be a good idea to go back and look at an income statement, one that contains cost of goods sold in it, right, so that you see the difference. I'm sure we'll come across it as we proceed. Right, so now they talk about product versus period costs. And what are the product costs? Direct materials, direct labor, manufacturing overhead, right? The manufacturing costs are the product costs. In fact, some books call them manufacturing costs, other books call them product costs. This book calls them both. And the period costs are the non-manufacturing costs. So product costs become part of cost of goods sold. I'm thinking of the income statement now, right? The inventory is on the balance sheet naturally, but the cost of goods sold is on the income statement. The period costs are the operating expenses on the income statement, right? And here they kind of show you what that looks like. Look at the non-manufacturing costs first, right? These are called period costs. Non-manufacturing costs, the selling, general, administrative expenses, they are period expenses on the income statement, whereas the manufacturing or product costs become cost of goods sold. Well, one other thing to keep in mind with manufacturers, we learned in Accounting 101, I guess, when you took that there's only one type of inventory, and that's an inventory of merchandise that you purchased from a supplier, right? Like Macy's, for example, they buy their sweaters, their housewares, their furniture, all the things in that store they bought from somebody else. They didn't make any of it. Well, the manufacturer, since they have to create the product from scratch, they need to buy the materials to do that. So that's one type of inventory that they have. They have a raw materials inventory. We'll see all of this as we proceed, right? But I'm just looking at this now, right? And I'm seeing this. So another way of saying direct material is raw material. So we have an inventory of the raw material that we need to make the shirt, for example. We have rolls and rolls of cloth, and they sit in a warehouse someplace. And then as we begin to make the shirts, we take the cloth out of the warehouse and we send it to the floor where the machines are, where they're going to be worked on, right? That's known as work in process inventory. And notice how direct materials, direct labor, and overhead, how they flow into work in process inventory. And then once the product is finished, it gets transferred into finished goods inventory. And then when the product is sold, it becomes cost of goods sold. Right? So this is a nice chart. When you first look at it, it looks a little busy, right? A little confusing, but this is very important stuff, right? Remember what I said, this chapter is very important because these terms and concepts will be repeated continuously for the remainder of the course. Now, what's the difference between relevant or irrelevant? I mean, look at your own life. Something that's relevant is something that's going to affect you. Something that's irrelevant won't affect you. So this is pretty much the same thing as it relates to cost. Something that's relevant is something that's going to affect your decision, could influence your decision, whereas an irrelevant cost will not. Right? So I don't know, this kind of says something similar to what we just saw. Right? It's just a way for you to decide where something goes, right? In other words, can we trace the cost? If the answer is yes, it's a direct cost. If no, it's indirect. Is the cost to manufacture a physical product? If it's yes, it's a manufacturing cost. Is it direct material, direct labor, or overhead? Those are all product costs. If not, it's a non-manufacturing cost. Is it a general and administrative expense, or is it a selling expense? Those are period costs, right? And will the total cost change in the level of activity? If yes, it's a variable cost. If no, it's a fixed cost. Okay. So I am going to stop right here. And in the next video, I'll get into your homework, right? So this video is just to give you background, walk you through the chapter, kind of explain what some of the major concepts are. But you should really take the time to sit down and read this chapter, underline what's important, or take notes to yourself. And I'll go over the homework in the next video.